Hi, my name is Walton Abraham Sanchez. I am the CPA of the firm Fast CPA and Consultants, and today we're going to speak about how the IRS taxes income from foreign companies. There is a case in the Internal Revenue Code for companies that are outside of the United States. They distribute profits to U.S. citizens. The Internal Revenue Code classifies those companies as Controlled Foreign Company, or CFC. In addition to that, the Internal Revenue Code also classifies the income or the profits that a controlled foreign company distributes to a U.S. citizen as a Subpart F income. Now, in terms of tax principles, a controlled foreign company is nominated or is classified as such when at least 50% of the U.S. ownership of the company is belonging to citizens from the United States. This is the concept of controlling. In addition to that, for the classification of the Subpart F income, the owner of the company, or at least one of the owners of the company, should be 10% stockholder or more. Whenever those two elements, the 50% ownership of the company and the 50% ownership of the company or by U.S. citizens and 10% for ownership of one single U.S. citizen, those two conditions create the concept of controlled foreign company. In addition to that, there are occasions or opportunities that people want to bend the rules. Instead of one person, U.S. citizens, controlling 10%, they will distribute that 10% or more between different families members with the objective of not making 10% to each individual family member. But the Internal Revenue Code also has prevented that or anticipated that and created the concept of rules of attribution. The rules of attribution create the concept of the 10% of ownership whenever there is family members, related members of the same family, that they own small ownership than 10% or smaller ownership than 10%. When the totality of that participation makes up 10% or more, then the company is a controlling foreign company, and the income of those individuals that is distributed from the company to those individuals is an actual Subpart F income, meaning it's reportable and taxable event. Now, in terms of reporting, the classical classification of Subpart F income is belonging to two types of income, either active income, whenever the company actively pays to the individual, to the U.S. owner, 10% or more owner of the company, and in addition, whatever is called dividends, interest, rents, and royalties, that they are passive income. So active income and passive income is both part of Subpart F income. Now, whenever there is these two elements, and income is from the company, either paid to the individual or dividends, rents, interest, royalties are distributed to the individual, 10% U.S. stockholder, that creates a reportable event and a taxable event. That income will be reported in the Subpart F or the SKU F of the individual tax return of the individual 10% owner or from the beneficiary from the distribution of the company. In addition to that, whenever the payment is not given and the dividends, interest, royalties, etc. are not distributed, that stays within the retained earnings of the company. And even if those payments or those distributions are not given to the 10% ownership, that still creates a reportable and a taxable event, meaning that even though there is no distributions of dividends or or active payments for consulting or whatever the payments are, still the company, even the company doesn't pay to the U.S. stockholder. Even if that happens, the U.S. owner, 10% or more of the company, is obligated to report in Scale F and pay taxes for those retained earnings in the company that are not distributed. In addition, the recent tax reform, the Trump tax reform, created two additional taxes. One is the retained earnings tax, that meaning that any taxes that any retained earning that has not been distributed is meaning to be repatriated, and the repatriation tax is percentages between paid between 8 different payments. It could be 8 different years, with percentages that go from 13.5% is the maximum tax applicable to those retained earnings. We recently did a video, you can check that in our YouTube channel, from the Fast CPA and Consultant YouTube channel here. And in addition to that, the income that is from the current year is also taxable event. So there is no more excuse as before that if you accumulate retained earnings in a company and you don't get the distribution from the offshore company or the foreign company, you are not going to pay taxes. That is not anymore the case. You are supposed to report and pay taxes on retained earnings during 8 years if you are not able to pay it in one single year, and as well pay taxes on the current earnings of the company, reporting all that on the Subpart F income. We have created a series of videos about this topic that you can check in our YouTube channel, Fast CPA and Consultant here. You can also subscribe to check more videos whenever we post them. And if you have a specific question about this topic, check here on the link that we have in the description video and send us an email, Fast CPA and Consultant. Thank you.